All right, so recently I had someone ask about Loblaws, and I looked into it a little bit. I've looked into Loblaws before, and I thought they were okay, but I do like them, so I wanted to make a video on them. I do think that they're a tad bit overvalued where they're at right now, but I'll get into that later. First things first, if you get value out of the video, please like, subscribe, check out those links below. So getting right into it here, 53 billion Canadian market cap, 1.14 dividend yield, earnings yield of 4.22%, free cash flow 6.44. And then if we look at Loblaws, so for people that don't know, I mean, the Americans definitely won't know. They're basically a grocery company, kind of a competitor to Walmart's would be they're not 100% one-to-one, but that's pretty much the best way of putting it, at least from what I can think of. Grocery, pharmacy, general merchandise, and financial products. So they typically do have pharmacies in their stores. So that's another thing they do. A lot of times they have eye doctors and like family doctors, and sometimes as well in their stores. So I think that's a good idea because it helps them diversify a little bit. They have the PC Optimum program. They do have a credit card as well that they issue. So I like that they're diversifying into other things. But I mean, at the end of the day, the vast majority of their earnings or revenue is probably coming from the groceries that they're selling, or general merchandise as they put it here. So let's get into the insights quick here. If we look at the insights, profitability, they're for a grocery store, they're actually, I mean, they're not good compared to your average company. But again, at the end of the day, they're selling groceries. It's not like they're a real high-end grocery stores either. They're catering to the average Joe. They're not catering to the rich people. They're catering to the average Joe. So, I mean, a operating margin of 6.6%, a net margin of 3.7%, free cash flow 5.6%. Those are actually pretty good. I think those are actually pretty good numbers. Return on equity is 19%. They've actually outperformed the S&P, which is also good. Growth is okay. Again, this is not a company that's going to grow revenue by double digits. Like, it's just not going to happen because the amount of growth that they would need to see is off the charts. But to be fair, one thing that I do like here is there's not a lot of really big cities in Canada, like compared to the States. Like there's just orders of magnitude more cities where there's over like 1 million people. But in Canada, there is quite a few cities, not compared to the States, but there is a lot of cities in that 10,000 to 5 to 10,000 to like 100 or 200,000 people that either need a store like this because the mom and pop grocery stores just aren't enough, or they have a Walmart, they have a superstore or whatever, but they need a second one. With Canada's population growth, I think that's definitely helping a company like this. If we look at the financial health, they're actually pretty good as well because, I mean, they have a current ratio above 1. They are aggressively buying back shares, which is one of the main things that attracted me to them. And then the dividend we'll get into later. Earnings and revenue are supposed to grow very nicely next year. Analysts are bullish, so I really like that. Also, I'll get into the valuation in a little bit, but they are above their historical valuations. Getting into the financials here. If you look at revenue going back 20 years, they've grown revenue about 5.6% per year, which is solid. That's a solid number. If you look at, I mean, if we just look at earnings here, this is on a quarterly basis. It's a pretty clear, steady, ladder or staircase higher, depending on how you want to put it. If you look at shares outstanding, I mean, ever since, it looks like 2015, back in like 2014, looks like they issued quite a few shares, but going back exactly 10 years, they've been aggressively buying back shares. I mean, they were at 427 million shares outstanding, and then the last quarter of 2024, they're down to 307 million. So they bought back, that's probably about a quarter of their shares outstanding in the last 10 years. So that is very, very good. And they're probably going to be able to continue that. Maybe not quite at the rate that they that they have historically, but they're going to buy back shares. And that's one of the things that I really do like. So looking at their profitability metrics, if we look at their net margin, the numbers are actually pretty steady here. In fact, it looks like they're actually growing slightly, which is nice to see. If we look at free cash flow margin, also, I mean, it's dropped off a little bit from 2021, 2022, but everybody knows what happened then. And I think that's kind of some extenuating circumstances. But, I mean, they still have a very solid margins. And, I mean, the highest those margins ever got prior to 2020 was like 5%, just under 5%. And then they've been kind of hovering around that 6-ish mark for the last 2 or 3 years. So, I mean, if they can just maintain that margin, to me, that sounds pretty good. Return on equity, return on invested capital, they haven't updated those numbers in a little bit, it looks like, for whatever reason. But, I mean, the last we can see, the number is pretty strong, and they're actually trending towards highs. So that's very good to see. If we look at free cash flow per share, also is hovering around an all-time high. So that's very good to see. Revenue per share is at an all-time high, so that's very good to see. Whenever you have a company whose profitability metrics are at all-time highs or close to it, and their revenue's at an all-time high, it's always a good sign, at least in my opinion. I don't think anyone would disagree with that. So if we look at the dividend here, this is another thing I really do like. Only 1.14%. A lot of people say that, no, that's nothing. But like I always say, the best dividend companies are the ones that are paying a lower number but are growing it consistently, as compared to the ones that have a high number that aren't growing it. A lot of people get that confused. So, I mean, they're actually increasing the rate at which they've grown their dividend. Over the last 10 years, they've grown at less than 8% per year. Over the last 5 years, 10.25%. And over the last 3 years, 12%. So that's also a good sign. I don't know if 12% is a number that they can maintain long term, but I don't see why they wouldn't be able to maintain that 7 or 8%, because, I mean, their payout ratio is 27%. So that's still a very low number. And I mean, if you go back 10 years, you would have a yield on cost over 4%. Even 5 years, you'd be at about 2.8. So that's the wonders of a company that is consistently buying back shares and consistently increasing those dividends. So let's get into the valuation here, because this is the hardest thing, is that how much is the company worth? I think we've established it. It's a fairly solid company, but how much is it worth? So if we go back about 10 years, they've grown earnings at just under 17%. They've grown revenue just over 3%. Average PE, their actual growth rate to their PE has gone down, meaning the growth to the company's share price has been driven largely through, actually entirely through, organic growth. So that's really good to see. The average PE during this time has been about 25.5. They're currently at 23.7. If we go back 5 years, let's go back 5 years roughly. Average PE has been 21.35. They're currently at 23.7. They've grown earnings at about 20% during that time. So my opinion on this company as far as their valuation goes, given their main business is selling groceries, I definitely would not pay more than a market multiple, because even though it's a good business, it's not a business that's going to grow consistently well into the double digits. Right, so if the S&P is growing at earnings at 12% and it has a PE of 20, I don't want to pay any more than 20 for a company like this. Even though they're fairly stable, like they are pretty stable, I still do not want to pay more than a market multiple for this company. So looking at these metrics here, if I assume they grow earnings at 10% per year, which is much less than the 16 that they've grown the last 10 years, they buy back 2% of shares, which is actually less than what they've done over the last 10 years. They grow the dividend at 8% per year, and you're paying 18 PE. That implies they're almost exactly fair value, about 174 a share. They're currently at like 175-ish. I'm recording this the day before it comes out, so it could change. That's what I'm getting at here. I want to buy this company below a 20 PE. That's the best. That's probably below a 20 or a 21 PE. That 5-year average of 21, frankly, I think that that's pretty much fair value. So I want to buy it below, like 21 is my max for a PE. So that implies that I would want to wait for about a 10% pullback, a current share price of around 175 to 180. That implies like what, 165 roughly is a fair share price. It has been there this year. It's actually been as low as 138. In the last week, it actually got down to about 173 and change. If we go back a year, the last time it's been that cheap would have been back in August. But it is down. It is down from its all-time high. It's down about 10% roughly from its all-time high. So long story short here, to sum it all up, I very much do like this company. Like, I definitely do want to buy it. But I don't want to pay more than a market multiple for this company. And the S&P PE is around 20, 21. I think it's right around 21 right now. So I want to get it below 21. So I would wait for probably a 10 or a 15% pullback here, or they're just going to have to keep growing those earnings. So one or the other. So basically, be patient. Don't get too aggressive. When it, like, especially, I mean, frankly, the Canadian economy is more volatile than the American economy. So it's only a matter of time until you get a pullback here. So be patient. Keep it on the watch list. Once you get it for that, below 20 PE, just to be safe, that's when I would pull the trigger. Just my opinion. Obviously, I could be wrong. Do your own research. But I'm going to leave it there. So to cap it all off here, if you like the video, please like, subscribe, comment, check out those links below, and stay tuned for more.